Hello and welcome to this video where we will be making an overview of capital investments. This is the very beginning of the relevant learning module, which focuses on capital investments and capital allocation, including the computation of NPV and IRR, those very important measures. Now, as you can see, I'm doing this video in the mind map format. That's because it's purely theoretical and I want to make it nice and quick. There isn't that much you need to sort of new stuff or exciting stuff that you need to learn here, but you will be happy to know. And this is, this comes as a result of many comments I've received on previous mind map videos that I will be making this mind map available for you to download. Look for the link in the video description if you want to have this mind map in front of you whilst watching the video. There's a link, you can download it, you can print it, do whatever. But be sure to scale it for size, because this is the size of your sort of printer, because it's a pretty big natural format. Right, so let's get cracking. What are capital investments? Right, capital investments or capital projects are investments that essentially are of a long-term nature. So the typical definition is that they should have a life of 1 year or longer to classify as capital investments. And they will typically show up or get recorded as long-term assets, long-lived assets on the company's balance sheet within the balance sheet under assets, and they will be typically recorded at the cost of purchase, the price paid. This expenditure doesn't enter the income statement, as you will surely appreciate. The asset is recorded at cost within assets, or the project is recorded at cost within assets, and then subsequently that cost is spread over the lifetime of the relevant asset. So the expenditure doesn't appear in the income statement immediately. Instead, a portion of it is recorded in the income statement as a non-cash expense, periodically as depreciation or amortization. You will appreciate that depreciation is the term we use when discussing tangible assets. Amortization is what we use when discussing intangible assets. Nevertheless, this goes to the P&L, the income statement, over the life of the asset as a non-cash expense. This, of course, means that capital spending, at least from an income statement perspective, or the P&L impact of capital expenditure, is smoothed over time and aligned, this is important, it's aligned with the benefits from the investment. So the whole idea behind depreciation or amortization is that, yes, you suffer a big cash outlay at the very beginning, and then hopefully, if this is a timeline, what will result are some benefits. And the point of depreciation or amortization is to take that big negative cash outlay and actually, instead of recording that in the income statement, take this and spread it over time so as to get matching. There is an important accountancy concept known as the matching concept or the matching principle, and that's what depreciation or amortization allows us to get from a P&L perspective. However, if you look at the cash flow statement, this is what will appear. This appears within cash flow, the actual cash outlay when it occurs, but in the income statement things get smoothed and spread over time. That is, a topic that generally will feature, or does feature, in the financial statements analysis section of your curriculum. Okay, now the most important thing here is the classification of capital projects into 4 types, and we'll get to that in just a moment. But before that, some general notes of, I think, a very obvious nature. It's important for us analysts, financial analysts, to understand a firm's capital investment process, capital allocation process, because capital investment, so what the company spends money on, give us a really sort of important picture or good picture into a company's future prospects. After all, what you spend money on is going to potentially give you these benefits in the future. So that's absolutely important. And as a result, these decisions on what to spend money on, they provide insights into the quality of management, their decisions, and also how the company hopes to create value. So, these are the 2 points over here, which I think are quite important, which I picked up from the curriculum. And of course, as I mentioned before, capital investments are not just about tangible assets, so things like property, plant, and equipment, but in today's day and age, they're increasingly aimed or oriented, focused on intangible assets. For example, increasing the digital capabilities of a company. So intangible assets, indeed. Right, now for what I think is really, really critical in this reading or this more, section or lesson, the 4 types of capital investment projects. And we are going to take them one by one. Number 1 is going to be going concern projects, followed by regulatory compliance projects, then expansion of existing business style projects, and then venturing into completely fresh new lines of business and other. Right. Good. Going concern first. Now, most of this is going to be absolutely self-explanatory and simple, I think. So don't waste too much time on this. Just watch this once and it should suffice. Going concern projects, they're also known as, aka maintenance, capital expenditure. And although from an accounting point of view, you probably wouldn't call that the maintenance, nevertheless, that's what your book says. These are investments which are made with the aim of basically keeping the company's current operations running, so maintaining current operations and the current size of business, maintaining the existing size of business as it is, so nothing about expansion, just maintaining, hence maintenance capital projects. So you can think about some examples: replacing assets which are near the end of their useful life, IT maintenance, hardware, maintenance, software, maintenance, or just maintaining existing or improving even or existing facilities. But that's not with the aim of being able to do more expanding, but just keeping the thing going pretty much as it is. From an evaluation perspective, the nice thing about these replacement projects or going concern projects is that they are quite easy to evaluate in terms of the cash outlays and the benefits, because you are already doing this thing. So you're merely replicating existing operations, which means that they are always, lower risk projects. In capital investment analysis and evaluation, you're going to have to project the future benefits, match them with the costs, compute things like NPV, IRR to check whether the project makes sense. Here, the benefits are much easier to ascertain because you already have an idea of how this stuff works. And when it comes to funding these projects, right, what often happens is matching the funding with the lifespan of the asset. So, for example, this is known as the match funding approach. This is a term which may be beneficial to sort of write down or in some way highlight: the match funding approach. So let me give you an example. If you're going to fund an asset or purchase an asset, build an asset that has a 20-year lifespan, and it will generate benefits over the upcoming, hopefully 20 years, then you would probably, under this approach, want to match it with issuing a 20-year bond. Okay, that's match funding. Simply, it's an approach that you have to know. Good. And right, from an analytical point of view, so when you're looking at from outside, how can you possibly deduce how much the company is spending on these kinds of going concern projects? It doesn't really, it's not so easy, because when you look at the cash flow statement, you just see a big lump sum known as, cash flow outlays on the purchase of new assets or investment assets, and you don't know whether they are going concern investments or maybe expansion investments, etc., etc. So what analysts often do is try to get an estimate of this kind of maintenance capex, also known as replacement capex, by looking at depreciation. How much the company is depreciating its assets or amortizing its assets. That should roughly equal how much it should be replacing to keep the thing going. Of course, there isn't really a one-to-one match there. I mean, even if a company has steady depreciation on an annual basis, it doesn't necessarily mean it spends that much money on an annualized basis in terms of cash outlays, because you don't replace in a nice sort of linear way. Typically you replace in batches, so the timing may be different. Plus, if you're going to replace something, the question is how much will it cost in today's money? After all, depreciation or amortization is the spreading over time of a past purchase cost, whereas replacing the same thing in today's sort of money under conditions of inflation will typically cost you more. So depreciation isn't necessarily a good guide in highly inflationary times. And the question is, depreciation is the spreading of original purchase cost over the assumed life of an asset. But assets don't necessarily provide value over that assumed life. Sometimes their lifespan is longer, sometimes it's shorter. Depreciation or amortization is just a sort of estimate, or is based on an estimate of an asset's useful life, which doesn't necessarily always work out perfectly, to be perfectly precise. And just a final comment here, that for shorter-lived assets, the accuracy of these estimates are going to be much easier, because they indeed, there's less question marks about how much it will cost to replace them. Depreciation is a much better guide for replacement cost, because inflation doesn't have so much time to kick in, and and there isn't that much room for error when it comes to estimating their useful life. If you've got a license, a 2-year license for some software, of course, replacing it will cost, it will last 2 years. There is no, maybe 1 additional year or maybe 1 year less, because the license is granted for a specific amount of time, and it will end on a specific date, and therefore it will have to be replaced after a specific amount of time. Okay. On to the next one, regulatory compliance projects. So these are very different to the previous ones. The previous one was at management's discretion, whereas here, it's not at the discretion of management. You need to carry out these investments simply to be in compliance with some legal or regulatory standards. So examples of this would be maybe, installing, some new type of filter to reduce pollution in line with new requirements, or maybe invest into new software to be able to do better enhanced financial reporting. Once again, because your regulator requires you to do so. This is especially the case with banks, who constantly need to up their game when it comes to, for example, risk reporting to the regulator, or transaction reporting to the regulator. And the bad thing here is, or the unfortunate thing is, that sometimes you increase the outlay. So this causes costs, of course, but it doesn't necessarily bring in any additional incremental revenue. But it's necessary just to avoid fines being put on you, or just to comply with the norms and therefore be able to continue running the business. That's the bad thing. There is, however, something good about this. You may be, so I put the negative here in the wrong place. Additional expenses without any additional revenue, but the more such regulatory requirements are in place, the bigger the barriers to entry for new sort of competitors, which potentially may lead to protect the company's profitability. So if you are one of the early adopters of this, it may enhance your competitiveness, it may enhance your profitability, and actually it may help you attract new customers if you sell it correctly, right? We have installed these, pollution reduction technologies, etc. So we are the leader in this field, and of course, some part of the public of your clients will be attracted to that pitch, let's say. Right. From a financial point of view, because these are givens, you can't really avoid these costs. Maybe you will be able to pass them on to your consumers. That depends on the industry, but it may also cause the company to rethink which lines of operation are in fact profitable, and maybe it will lead to the decision to wind certain things down if it turns out to be unprofitable, taking these costs into account. So, the returns of a company, the profitability of a line of business are always assessed on a post-regulatory cost basis. You have to factor them in because they are unavoidable. And if those returns are proved to be, below zero, then there's no really sense to carry on doing that thing, whatever it may be. Now, the really exciting stuff is expansion, or going into a completely new line of businesses, which is what's coming next. Expansion is all about a business looking to grow, so to increase the scale of operations, existing business activities, but also expanding their scope to, let's say, somewhat new areas, or actually entirely, enter new areas of business. Although those new lines of business will be explored kind of separately. So here we are primarily focusing on expanding what you already do. Now, the risk, the nice thing is that you actually know how that business line works. So you're merely expanding it and taking it bigger in an existing market, or taking it to a completely new market where you are not present yet. The risks are, typical operational risks. So things like, where are you going to get the additional inputs from? Where are you going to source the additional raw material, for example? Where are you going to get the labor from? What about production bottlenecks, right? Can you budget properly for all of this stuff? Often, if this is a company in the early phase of development, these types of projects will be financed by equity financing, because debt providers often perceive this as being too much of a risk. Okay, now moving on, sometimes what will happen is you will want to move into a completely new line of business, which is exciting, but it's the most risky type of investment, to go completely outside your area of expertise or an area which is minimally related to the existing business. Obviously, this would be motivated by the potential for growth, innovation opportunities, but of course comes with higher levels of risk due to the unfamiliar business that you're getting yourself involved into. These are the riskiest projects, so they will, have startup characteristics. They may involve, new technology development, new business model development, acquiring a company that already exists in that sector, which brings with it the classic risk of potentially overpaying for acquisitions. Okay. From an analyst's perspective, of course, these require a lot of due diligence, and expansion capex may be estimated by looking at the cash flow of the company and trying to subtract what you estimated to be maintenance capex. Of course, here, when we say expansion, we mean both expanding an existing line of business as well as moving into something completely new. If you have the total outlay for capital expenditure and you deduct the maintenance, the stuff that you typically estimate using as a proxy depreciation and amortization, so going concern, maintenance or replacement project, what you're typically left with is the expansion capex or capital expenditure. Although, that completely omits the regulatory compliance type of projects, which you'll not be easily able to assess unless the company specifically gives you those figures. So, here are some very initial notes on this topic. Just be aware of this split into the 4 different project types. Very easy theoretical, nothing to study, at least too much here beyond just watching this initial video.